over here, just watching everything as it happens as I usually do. And I have a presentation to share with you all if you're on my YouTube. That's pinned up on my profile on Twitter if you're listening there on Spaces. But we'll go through all this. We'll talk a little bit about what's going on. First, I'm just going to do some introductory stuff. So, I'm Markets and Mayhem. I'm sure you probably know me by now. I've been doing these every Tuesday at 9 a.m. for Bookmap for a little while now. And, it's been fun. So, I've started trading in 2005 and really focused on stocks and then options, got into futures, navigated my way through the great financial crisis. That's where I got much more passionate about macro because, of course, what better time to learn about how important macro is than during everything that was happening then. So we're going to talk a little bit more about all of that. I'm just going to take one moment to just do a few things behind the scenes here. So just give me one moment as I do that. And as I'm working on this, if you have any questions about anything, feel free to reach out. I'm always happy to discuss what I'm doing, make sure that everyone's getting a benefit from, participating and seeing what I'm doing. I want this to be both about kind of me sharing what I'm looking at in the markets, but I'd also like it to be about, teaching because I've been at this game for a little while. So if I talk about things that you don't understand or want to learn more about or whatever, feel free to post a question. If it's on Twitter, you can post it and reply to the spaces. If it's on YouTube, you can post it in the chat. And if it's on Discord, you can tag me in and post it there as well. So let's get this show on the road. This is my contact info. You'll see it on screen if you're on the YouTube right now. And that's Traderade.com. That's where we talk about short-term trading to intermediate-term trading. It's all about education and actionable ideas. We also have custom tools that are pretty darn cool, looking at how options impact the market. That's been a foray where I've actually been doing a lot of my own coding, and we'll look at one of those tools during the stream. Macrovisor is a project that I'm working on with my partner Aisha to focus on the big picture and how that makes actionable longer-term trading and investing themes. So we make macro actionable. You can find me on my own YouTube. That's at Markets for Mayhem for Markets. Mayhem for Markets. Got my own name wrong there. That's what kind of day it's been, right? But you can find me there at YouTube. It's youtube.com/@Mayhem for Markets. And then finally, if you want to get Bookmap at up to 40% off, which is a deep discount to be sure, you can visit Traderade.com/Bookmap and scroll down to the specials. So let's do the favorite part of everyone. Everyone loves this part of the presentation the most, right? This is where I read off all this text really quickly about the disclaimer. All Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. All right. So first slide we have here today is the pre-market, the what's going on in futures. It's a bit of a bloodbath out there in the world of commodities. Gotta say, if you're not watching this on screen, you can by just clicking on the YouTube link that's pinned to my Twitter profile. But basically, we have a heat map that shows oil, gas, heating oil, natural gas, and ethanol all taking it on the chin this morning, joined by gold, silver, platinum, copper, palladium, live cattle, feeder cattle, soy oil, corn, wheat, oats. Needless to say, it's not a great place. There are a couple places to hide in commodities today. Lean hogs, canola, and orange juice, as well as soy meal, have a bid. The dollar's up a bit. It's up about 0.4% here. The 30-year bonds up about 0.6%. And equity futures are down just a touch outside of the NASDAQ, which was flat as of the time of taking this photo. But it shows us just a little bit of change in heart in these markets. The bid for commodities has dropped. And I think that's interesting to see how this plays out. Obviously, one day does not make a trend. So we will be watching this to see how it all goes. But I think it's still going to be important to kind of take into consideration that this is pretty big what's happening behind the scenes here. Oil broke its uptrend pretty meaningfully over the last several trading days. And it had been pretty healthy. And, it's not as if the tensions have gone away. It's more that the market is doing what it likes to do. So you'll remember if you were trading during the Ukraine-Russia situation, when that was escalating in its first couple of weeks, when troops were moving in from Russia, oil was getting a huge bid, and it was absolutely just off the charts. And then, as we went through that whole situation, the market started to look past it more and more and more. And then eventually, we sort of stopped paying attention to it at all, unless it was a major headline over in Ukraine. It wouldn't even impact the price of commodities. It wouldn't even impact the markets that much. And we're kind of getting to that point in the current conflict as well. So the events are no doubt tragic. There's a lot of innocent people that have been hurt, and it's very unfortunate. But the markets at this point are looking past that. And so we're now on the other side of it, where we see commodities, particularly in energy, and gold, which is the uncertainty hedge, getting hit pretty hard. I think that's important, that change of character. Also, just wanted to note that RBA hiked last night. Their new central bank governor hiked last night, and yet the Aussie dollar is getting smashed. It's down 1.12%. So that's interesting. So some interesting reactions in the world of currencies lately, put it that way. I'm going to move these guys off the screen here. We'll put them back later. This is more about Bookmap. So this chart on screen here is commodities versus S&P cash. And if you're not seeing the video, what it's showing us is that there is still a relative strength trend here, although this was taken before market. So it's going to be interesting to see how this plays out, right? We may not see this relative strength chart hold up if this type of trading continues. So right now is going to be pretty important, really, today, how things resolved in the world of oil in particular is going to be very important, because that's been the leadership in this commodity boom, and it is rolling over. And as I said, we'll look at the technicals in a little bit, but this relative strength chart was one reason to really be bullish of commodities. If it breaks down, it's going to look like the opposite. And if that trend changes, it'll be a reason to actually start looking for bearish opportunities in some of these weaker commodities. Now let's look at the New York Stock Exchange McClellan oscillator on screen. This was really overbought going into yesterday. It had a reading of 95. That was part of a breadth push higher, and that's fine. There's nothing wrong with markets getting really excited and seeing lots of strong breadth last week. But what we did see underneath the surface that was somewhat disconcerting was there was a lot of outperformance by the lowest quality factors. The most shorted stocks were getting a huge bid. And, Russell kind of sort of falls in that bucket as well, although we'd love to see more outperformance by small caps, because that's one thing in this market this year we really haven't seen. In fact, the Russell's down year to date, and typically, and we'll talk about this as well, small caps are leadership in a real bull market. Nevertheless, we did see yesterday's sort of sideways to higher price action help to reduce this reading. So we're no longer quite as overbought. We're more at a point now where we're just kind of seeing a little bit of a retracement. So on that factor, looking a little better, similar with CBOE equity put call ratio came off of that euphoria reading. So again, looking a little better there as well. Now, this is an interesting chart. This is a chart of the NASDAQ in red and the 10-year note price, not yield, in black. And what do you see here is this really big ramp in the, apologize for my terrible drawing, in this correlation, right? Over a 50 rolling trading day period, it's now 0.82. So I know for a while interest rates didn't seem to matter for stocks. They do seem to matter again in both directions. So seeing rates drop recently helped to give stocks a pop. And if rates resume their ascent, that could have the opposite effect. But at the very least, it's really important to pay attention to this relationship, because over the summer, as you can see, there was basically no correlation. It went inverse, actually, right? And now we're back to a positive correlation with the price of U.S. debt, this chart showing the 10-year, and the performance of the NASDAQ. And we can see that in other areas of the market as well. Now, this is a chart of the yield curve. This is 2s and 10s. We're still pretty inverted here, about negative 26 bips. I think it's interesting because, in my mind, just speaking of rates in the long end, I'm really looking for this to move higher. And this is something that Aisha and I have talked about quite a bit, that we believe there's still room for a bear steepener, meaning that in our work, when we're looking at the macro and we're looking at what's going on in the world of debt, yes, the quarterly refunding announcement came out with less total issuance on the long end and maybe less total than the market was expecting. But maybe we should guard our expectations and optimism on that, because the Treasury also has a habit of coming out and upsizing their issuance sometime during that same quarter. And the other side of it is the biggest bidder at auctions was the Fed. We also had foreign counterparties, in the past, like China, Japan, and Saudi. They've all stepped back meaningfully. Now it's really U.S. households and to some extent, retirement funds that are buyers at these auctions at the margin. We've got big auctions this week as well. So we'll be able to gauge the appetite for these treasuries. We've got, I want to say about 120 billion in notes and bonds, including one auction this afternoon, to pay attention to get a better sense as to where the market is on this. But my expectation, and Aisha's work agrees with this, and she's looking at it somewhat differently, but we come to the same conclusion, is that really the long end should appreciate in terms of rates faster than the short end. The short end's probably done. It might even move down a little bit from here, but it's probably about done. But the long end, if you're lending someone money for that long, like 10, 20, 30 years, there should be a premium for that risk you're taking that exceeds that of what it is right now. Whereas you're getting paid better for 30 days of exposure to U.S. government bills than 30 years of exposure to U.S. government bonds. And it's just not a scenario that makes a lot of sense. Typically, there's a premium. That's how the entire banking system is sort of constructed, and then borrowing from the short end, lending at the long end. And so as long as this inversion exists, it has a lot of consequences that aren't ideal. And I think that it would actually be much healthier for our financial system to see a normal steepened yield curve from the short end rising into the long end, rates appreciating with duration, because that's how the whole system is set up, right? And at the end of the day, it makes sense from a risk perspective for the long end to trade at a premium in terms of rates to the short end, because you're taking more risk on currency. Will the dollar be worth the same? The government's fiscal situation, what's it going to look like 10, 20, 30 years from now? So, seeing the 10-year maybe trade higher than 5, maybe 6, wouldn't be terribly surprising as we sort of work our way out of this inversion. Now, as we see rates rise, this actually offers interesting opportunities. This is one of the things that I think is kind of, it can be missed underneath the surface, because often is the case we're just looking at the S&P or the NASDAQ or the Russell or the Dow, but it's really fun to drill down into sectors and factors, because that's where you can find opportunities really no matter what the market's doing. There's going to be opportunities to trade, and particularly on a swing time frame. So I love to use relative strength and relative weakness as a qualifier for these longer term trades. And when I'm looking at that in the world of small caps, I'm plotting on screen IWN versus IWO. For those not familiar, that's the small cap value versus small cap growth, okay? Small cap value is outperforming small cap growth in a pretty decisive way. And for me, this tells me there's a trade, because it's been going on really since August, this outperformance, and it's continued to amplify. It's continued to grow in momentum. And so we have enough of a time period to say this is not just an anomaly. It's not just a hiccup. There's something to this. And we're also seeing it in a broader set of interfactor ratios. So if we look at large cap value versus large cap growth, we're now starting to see some outperformance there as well over the last month. Shorter time period, but it's showing you that maybe this trade is starting to broaden out. Now, when you think of a market that's been really led higher by growth factors and really a handful of stocks in that are the largest, if we're going to see an extension from here, I would like to see different leadership that isn't quite as expensive. So looking at value as either a long or, in my opinion, a pair trade actually offers some opportunity, because the other idea here is as rates rise and as the Fed works to sort of end this credit cycle, value is also more likely to outperform growth in that environment. So these are companies that tend to have better balance sheets, free cash flow, and even the small caps. And Horse, I see you out there, so I know that you don't approve of me talking positively of any component of the Russell, and I'm just messing with you. But even the small caps in the Russell look like they're ready to outperform growth over the longer run. And I think that trade could also be extrapolated out to the larger caps. If we look at the S&P 500, there's also an opportunity to start that pair trade of long value and short growth in those larger caps, I believe, as well. Now let's take a quick look at sentiment on screen. We have AA bulls versus bears, and the last survey data actually came in the third lowest for 2023. So, us retail folks, we've been washed out here in terms of our sentiment. Now, often is the case that after a washout event like this, you do get a strong bounce. The question is, because this data is current, I want to say as of Wednesday of last week, whether we already got that strong bounce or not. It's going to be interesting to see how we go from here. Markets are in kind of an interesting position here technically, which we'll go over shortly. But this is, at least in a vacuum, this reading when it was taken was exhaustively low. This was basically just people capitulating. So to see that kind of exhaustive low, that's at least healthy. A lot of, sad to say it, but a lot of people got flushed out of the market. And sometimes that's what it takes to get a rally like we did off of those lows, is to see what are referred to as weaker hands, or people that don't have the same conviction or maybe got in at higher prices, get flushed out of those positions. And then, the sad reality is that those same likely have to come back and buy in at a higher price when the market resumes its march. Speaking of buying, we have managed money positioning here. This is the NAAIM survey. It comes out every week on Thursday, usually in the afternoon, with data current as of Wednesday. So last week, these folks were still pretty pessimistic. Now, remember, 2 weeks ago, they were buying the dip pretty aggressively, and then they just absolutely just got rid of all of that. They went to the lowest levels of net exposure in 2023, levels of net exposure we hadn't seen, I want to say, since November of 2022. And now they're just starting to creep up again. This is another survey that ended on Wednesday last week. So we don't have Thursday, Friday sentiment data or positioning data in either of these surveys, but it at least suggests there was a pretty meaningful washout going into those more powerful days. Now, one thing that's interesting about the environment we're in, there's a lot of disagreement about whether this is really a bull market or not. I'm very skeptical of calling it a bull market, and this chart drives that point home, because for every single bear low from 1982 on, small caps and equal weight led. We're not seeing that this time. Market cap weighted indices are leading, like the S&P 500 and the Nasdaq's market cap version versus equal weight version. And of course, as we all know, the equal weighted stocks this year are basically flat. The small caps are pretty sure they're flat to down after Russell's powerful rally last week. And of course, the market cap weighted indices are outperforming. So this is still something to kind of keep in the back of your head. If this is going to become a healthier, more constructive regime, then we need to see a broadening out. We need to, and we saw some of that on Friday, which was great, but it didn't continue into Monday. 75% of issues were actually down. So that breadth thrust didn't have the legs to keep pushing. So this is something to just kind of keep in the back of our heads here, that small caps and equal weight, if there is going to be a continuation, should be, if this market is anything like, really every market over the last 40 years, should be leading. And they're not. So we want to see them take that leadership role. And another chart that drives that kind of same point home, the lack of breadth, is this new highs versus new lows. On screen, we have the NASDAQ. And what we're seeing is really from 2022 on, it's just been a story of new lows. There's been very few new weeks with new highs dominating, and that's, again, a sign of weakness of breadth. Yes, there's great leadership in these concentrated, very big stocks, but as we drill down underneath the surface, there's still a rolling bloodbath happening in the NASDAQ, and over the last several months, that's intensified again this year. So if we look at year-to-date performance and we're zooming out beyond the S&P, it is a mixed bag. You can see the strength of the mega caps and some of these healthcare and biotech names really holding the market up, but pockets of weakness all over the place in this heat map. So again, illustrating that picture of less breadth. We want to see this change if we want to be constructive on the market. That breadth has to really improve in the small caps and in the equal weight. So let's look at the options data as we get started here. 4400 S&P is a very important level, to be sure. That's the largest area of exposure on the options chain right now. It's likely to provide some resistance. We call that a call wall. This is from our algorithm at Traderade, where we're actually going through the CBOE options chain, analyzing about 10,000 different contracts, over 200,000 different data points, and calculating this. And it's actually updated every minute as markets are trading. These figures don't change as much, but we also have the 0 DTE data. So 4400 SPX is a really important level. I think if buyers are able to take price above there on a closing basis, we've got some room for continuation. On the other hand, if we keep bumping our head there, sellers might get some ideas about, this could be a level they could start to sell against. Looking at the gross gamma exposure below us, 4300 is a pretty important level, as is 4350. Crossing below 4350, if that was to happen, and again, this is cash, this is not ES. ES is about 17.5 points higher. But if we were to cross below 4350, just from an options basis, that could introduce more volatility into our trading dynamics. It would also push us closer towards negative gamma, although we are in positive gamma for now. And right now, that gamma flip level is 4342. So as of yesterday's close, just 24 points above. For those out there that aren't sure what this means, the simple explanation is in positive gamma territory, market makers are more likely to sell rips and buy dips. That compresses vol a bit. That's the dynamic we're in right now. And if we get into negative vol, it becomes inverted, right? So then you have more selling of dips and buying of rips, and that can increase volatility. So let's look at the S&P 500 futures contract here. We can see that it broke out of this descending channel that I've drawn, and it's building some volume above. So overall, it's looking constructive going into today, but I am going to be very interested to see how we trade, particularly in the first 20 and 30 minutes. Remember, going into today, we have some constructive flows from delta and theta decay with skew coming up again. We have beginning of month flows, pensions topping off, getting out of the blackout period for buyback. So there's a number of things that could help to push the market higher. You also have CTAs that are still probably quite short this market. Last exposure information we have from Goldman suggests they have something like $45 billion worth of buying to do over the next month. Similar picture in bonds as well. So it'll be interesting to see if all these marginal buyers are able to push the market higher. But I think everyone is really going to be watching rates. Rates have been the big driver of price discovery. To a lesser extent, we had geopolitical risk, but that seems to have faded, and attention seems to have come back to rates. So that's also where I'll have my attention today after the open. Now let's look at the NASDAQ. It's a very similar picture as the S&P. It's starting to bump above that upper trend line. It's starting to push above this multi-month point of control. It's looking more constructive here. It's not a look that I would want to just fade reflexively. I want to see what happens today with that opening range, as well as how we're trading in rates. Today, it looks like rates have a bid. That is to say that they'll come down as bonds are actually being bought. At least going into pre-market, that's what it's looking like. So far, looking relatively constructive here on the S&P and NASDAQ, but it's going to be all about continuation. Now, the ZN contract, this is the 10-year note futures. We can see it had that spike higher on Friday into a key level of resistance determined by both the volume profile and previous price action. That rejection there has me thinking we could actually see rates start to press higher and price move a little bit lower. It looked like that was a bit of an exhaustive move, so wouldn't be terribly surprised to see that retrace. And again, that's one of those mixed signals that has me really paying attention to rates as well as this opening range today to get a better feel as to what the market's telling me. Now, crude, this is a nasty look. It broke below this second trend line here that it was attempting to defend earlier. It's now below this point of control. That's volume profile from the year, basically the start of the year to the present. RSI is rolling lower. It's well below 50. Can't like it here. I've been bullish on energy, but the technicals tell me it's time to be cautious, and I'm not going to fight price on this, even though there's a good big picture thesis to be long oil. The technicals tell me there could be some more downside here, so I'm stepping to the side and watching to see what happens next in this trade and seeing whether or not we get a push back into the trend, which would be very constructive. If we had a look below and it didn't last more than today and we push back above the trend before close, or whether we see some continuation of the downside, particularly below that lower volume node that's just under where price is. We'll have to watch and wait, see how that plays out. We have gold on screen, though. Gold is looking pretty terrible, which I'm sure, again, is making my partner Horse very happy to see that, because we both wanted to kind of explore the other side of this gold trade. It got exhaustive to the upside. A lot of this was driven by fear, and that fear seems to be fading. Whether warranted or not, the market is telling us that that barometer of uncertainty has been dropping. Gold also hasn't been able to get much of a bid as the dollar's weakened and rates have come down. So that also is kind of telling us that relative weakness is a sign that maybe there's more room to the downside in the precious metal. So we're watching that very closely, looking for downside to 1916. This was a trade that I put out on Traderade yesterday and have been tracking really since last week's midweek update for an opportunity, but now we're finally seeing the signs of that breakdown. And if we get below 1916, 1845 would be on the table, and that's where I'd be looking to cover runners in this short position. We can see RSI's rolling over as well, so it's kind of just giving us a sense that momentum is stalling out. So I would like to see some continuation on this to tell me I'm right, but I think that if we break below that point of control that we're testing today, that's going to bring us down another basically 50 bucks. So that's everything on my slides. Let's go into Bookmap here, and we'll take a look at what's happening pre-market. Just going to grab myself a drink. I'll be right back. All right, folks. So S&P's got a little bit of a bid into yesterday's most active call level pre-market. And these levels are what that algorithm that I was talking about, it maps it out so that we can see it in Bookmap, we can see it in charts that are dynamically generated, and we can also have text-based output from our friendly Discord bot Gur. So it's kind of cool. We get to track the relationship between how options are impacting the price of the S&P and do so in pretty close time. But pre-market here, overall, looking relatively constructive. But again, we're going to wait for that opening bell, which is less than a minute away, and see how this thing trades for the first 20 or so to get a better idea of whether we might be setting up for a high probability trend day. NASDAQ's not looking too bad either. Pretty sprightly. Got a nice push here from 9:15 a.m. on. Some of these small traders got pushed out. You can see the stops on screen if you're watching the stream, about 386 contracts. Now, that doesn't sound like a lot if you're used to looking at the S&P, but NASDAQ order book depth is, well, not much at all. Right now, 8.4 thousand contracts, right? So when you see that much, like 5% of the book pushed out, that's pretty big. Looking at, speaking of contrast in order book size, we're going to look at the 10-year note futures. This order book has 586,000 depth. That's huge, right? So you see people just casually trading thousands of contracts, and it's not as big of a mover of price because it's such a small fraction of the order book. But pre-market, just sort of trading sideways here. See, the bell has opened now. Bell has rung. Gold trading downwards to sideways here, and crude, wow, broke below 79, now trading just above 78 here, 78.86. That should be helpful to rates. That should be helpful to push rates down if crude continues to weaken. Let's go back to the SPOOs here now that the market's open. And I'm going to zoom out so we can see some of these options levels just visualized in Bookmap as well. This is something that if you're on our Traderade Plus Discord, you can actually see these levels right there on screen. Just a bit of pressure in the open here. See if there's any large levels of resting liquidity come in. We've got a pretty decent sized offer, 317, 308 now at 4,400 above, and we just had a bid 263 come in at about 43.78, and it looks like we may be heading there first. Yeah, I think we have 11 Fed speakers this week, including Powell twice. So, the Fed, after they get out of their blackout period, just wants to come out and tell us everything that's on their mind. I don't think these meetings will be big market movers, though, because unlike some of the prior Fed speaker engagements that happen closer to their decision, this is pretty far. December's decision is over a month away. So whatever views they espouse now could be completely different in the course of the next 6 weeks. So I don't think that anything, and maybe Powell, that would be different. He's pretty important. The Fed kind of lines up behind him. So those Wednesday and Thursday speeches could be more of market moving events, but the rest of the speakers I don't think are going to matter that much to this market. I think it's going to be more important the economic data we get with unemployment claims, which so far continue to come in really low. Not worried about those unless they start pushing 300,000. And then the University of Michigan consumer sentiment. Be very interested to see what the final number for inflation expectations 1 year ahead is. Nintendo reported earnings, by the way. They actually did pretty well. This was something that we had talked about on Macrovisor as a potential turnaround. Still waiting for the new iteration of a console with them, but the company does look like it's an attractive allocation in the world of gaming. We did take out that resting bid in the S&P. You can see that on screen if you're watching the stream. And it does look like sellers are starting to take control so far at this open. 3 minutes into it. Let's look at the NASDAQ here, our high beta machine. Yikes. Really quite the retracement all the way back to where we were at 915. We do see some resting bids building below a bit in the NASDAQ, but it's on both sides of this. This tends to trade a little differently than the S&P because it's not as much driven by options, whereas the S&P almost entirely is driven by options. In fact, the majority of the footprint that you see in the volume profile are market makers hedging their positions rather than futures participants natively trading the ES. Just a fun little fact there because of how much options influence the market now. Let's take a look at rates. So we do see treasuries getting a bit of a bid here. I'm going to go out on a limb and say maybe oil is softer, but first let's look at gold. Gold's falling too. Look at that. That trade is starting to play out a little bit more. You do have a decent size resting bid in gold here. Remember, this is another one of those contracts where the order book is just tiny. So gold's order book has 7.3 thousand depth. Not very big overall there. So when you see a resting bid that stands out on the heat map this much, it's actually meaningful. All right, then. Let's go back to the S&P, but first we'll take a trip over to Oilville. Now trading down to 78.50, so that is quite a bit lower. We are seeing sellers drag down the point of control and VWAP a bit here. Bearish look in oil to be sure. That breakdown from the trend continuing here in the cash session. And when you get a trend break like that, you typically have participants that are caught on the wrong side, that are no longer in the money on their positions, and start stopping out here. So I think we're seeing a little bit of that distribution as well in oil, which is, again, it's good for rates. We're seeing them come down on this, but let's see what happens with equities here, which are still pretty weak into this open. As I'm talking, if you all have any questions, feel free to drop a note in the replies on Twitter, in the YouTube channel for Bookmap, or on their Discord. Just tag me in. I'm just going to take a look around real quick. Seeing some more selling pressure here in S&P. Take a look at the NASDAQ here. Yeah, this is now taking out the pre-market levels. This is actually looking quite bearish on the NASDAQ. If you're a 5-minute opening range trader, this is a short based on that violation of that 5-minute opening range and that continued push lower here. And we're building volume down here, seemingly building some acceptance here at lower prices. So if anything, the NASDAQ looks like a short into the price action we have right now. And rates are continuing to show some relief. This is a decent bid from the lows yesterday in the 10-year note futures. So just taking note of that, and then, the market seemingly not very concerned about that relief, continuing to see pressure. That's interesting, to be sure. Gold also not really benefiting from the drop in rates, by the way. Gold is a competing long duration asset. So when rates fall, gold should see a bid, but because of that exhaustive rally it's had, it's more looking like it wants to retrace. I think there's people that are kind of stepping on each other's feet trying to get out of this trade. And remember, with gold, historically speaking, when it gets a huge bid and it happens in a very short period of time, and then whatever was causing that bid to happen is no longer a front row concern for the market, it typically reverses a good chunk, if not all of those gains. That's just how gold trades. I've traded it since 2006. It is violent. It is unforgiving. It is very driven by psychology and momentum. And when everything seems like it's sort of the perfect reason to get long gold, as I'm sure a lot of people were doing, maybe $20, $30 higher here, the opposite often happens. So it's just a reason to be a little cautious on this one. I'm not saying you can't trade gold and make a lot of money. You certainly can. But being a contrarian and letting price be your guide in gold is so, so important. It's important in every trade, but in gold, all the sort of like, oh, the dollar is going to die and, the world's going to hell in a handbasket and gold's going to $10,000 an ounce, that sort of nonsense is best tuned out completely, 100%. Just pay attention to what's on screen. Look for the drivers from rates and the dollar and the other intermarket dynamics. See if they're playing out. But most importantly, look at the trends. And I'll tell you one thing I like for gold swing trades is the 50-week simple moving average as a guide for momentum. You can throw Bollinger Bands if you want to see extensions and Bollinger Band squeeze breakouts. That's another way to kind of enhance your visibility of the momentum and the health of it on that trade over a longer time period. But that 50-week moving average for gold is quite an important area to watch. And since we're talking about it, it would be silly for me not to have a very quick look. So let's just take a look at that. Yeah, so that would be 1932.81 would be that 50-week simple moving average number right now in gold. So we're still a little ways above it, but I've found that to be when we cross above, we tend to have continuation. Similarly, when we cross below, we tend to have continuation. It's not a perfect science, and looking at the weekly close, cross above or below, is really the key for this. But it's a very interesting line in the sand, and back testing it tends to be tends to show that it's pretty useful, particularly over the last decade. And gold just continuing lower to that resting bid down below. So again, even though it's not a huge amount of contracts, you can see that it matters and it's pulling price because in a thin market, the auction wants to travel to where there's liquidity to release, and there's certainly some liquidity down there to release. Speaking of, we're now looking at crude on screen, and 78.30 to 78.35. There's a decent amount of resting liquidity down there as well. So if we're going by that same idea that really auctions that are in a relatively illiquid market want to move down to release liquidity, and crude's now quite a liquid order book of 6.6 thousand contracts, going down there and filling those bids is not terribly unlikely, which would put us down about 30 cents. Seeing a bit of a bid come back to S&P futures here, but also seeing resting liquidity building below a little bit more in terms of size. NQ though, look at that bid there. That's huge. That is very impressive off those lows. Pushing above the point of control, pushing into VWAP here and testing these levels. We do see some iceberg distribution. Looks like an institutional seller took off just shy of 200 contracts into that push. And again, because this is not a very liquid contract, that's worth paying attention to. It's about 9,000 on the order book right now for the NASDAQ. And this is also why I prefer the 20-minute opening range, because a lot can happen in 5 minutes. So I look for the longer term opening range breaks, as I feel that they both, statistically speaking, have a better chance of a trend day, but also it keeps me out of this choppy chop that happens right after the open with so many different flows almost fighting with each other. And we're seeing a pretty decent reversal here, pushing above VWAP on the NASDAQ. Volume's getting a little thin up here, though. Could see that with the size of the bubbles on the Bookmap heat map. When they get really small, those are very small orders that are transacting. The larger ones are always more interesting to me because that shows just a little more conviction. Nevertheless, we do see this sort of chop building above VWAP and the point of control. So on a very short time frame here, you would think buyers are going to have a bit of a tactical advantage to try to push this higher. And again, for me, I'm looking for that 20-minute opening range at being defined by the highs and lows in the first 20 minutes of trading, and then which way price moves and starts to build volume to show acceptance. That's how I like to qualify a trend day. Rates still looking pretty constructive over here. 10 years seeing still some more bid. It actually got up to about 108, retracing just a little bit of that now. And you've got that, reasonable size resting offer above at 108.010. Some small contracts being pushed out, smaller traders being pushed out of this thing, probably short at 452 contracts on that stop. That's what these red dots are above. That would be a buy stop. Gold continuing to push lower. Look at that. It did take out that resting bid like a magnet. Let's see as we go lower. Wow, I don't know that's going to happen today. We'll see. But 1958 is the next largest resting bid in gold, and they continue to stack them lower here. So gold, in terms of just what the algos and larger traders are thinking, they want to either exit shorts or get long, but at lower levels. So it's important to think about that in the context of the momentum intraday, that in an illiquid auction, these tend to act a bit more like a magnet if they line up with trend. Crude getting a little bit of a pop here from 78.50, but once again, the majority of the liquidity is below it. And reasonably sizable given how small this thing is. Only 6,500 contract order book depth. And you've got 130 on the bid at 78.30. So that's reasonable. That's pretty chunky. You know, if you've got like 2% of the book just hanging out there, it's something that's worth paying attention to. And it's interesting, here we are back on the S&P contract, and we're looking at this 43.70 level and just below it. So you've got that resting offer at 43.70, and our algo is calculated gamma flip just below that, and the volatility trigger just slightly below that, which all comports to, you know, how the options market could impact this. This is going back to what we were talking about earlier. Pre-market, that would be about 43.50 on SPX cash for that vol trigger, right? So if we do move below those levels, that is likely to make this market quite a bit more choppy intraday. And I want to just express my gratitude for everyone that's tuned in. We've got about 12 minutes left. So if you've got any questions, if you've got any thoughts you want to share, feel free on the Twitter spaces and the replies, on YouTube in the chat, or on the Discord. Just tag me in. Just going to take a look at some of the options flow this morning now that we've had some time to see some transactions go through. Iraq oil minister says oil exports from southern fields increased by 350,000 barrels per day. So that's certainly not bullish for oil, seeing some addition of supply there, partially offsetting some of those other cuts from OPEC plus. See if that had any impact on oil or if that was already sort of being priced in. Looks like that was already being sort of priced in by the market, who may have already had that info. Nevertheless, in oil, we're seeing the point of control being dragged down by the sellers, and that's not a particularly bullish look. We're just testing that level now from below. Gold, again, you've got that big resting bid at 1958, just $10 down. We'll see if sellers are that aggressive today. Rates are kind of working in their favor. But on the other side, the dollar is, well, it's got a modest bid to it, up about 0.5%. Commodities, just lots and lots of red, I was saying earlier today. It's interesting. We'll be looking at some of these charts later and see which ones look like opportunities and in what direction. Rates given back a little bit on the 10-year, just softening a little bit from those gains earlier, not quite getting up to that larger resting offer on here. NASDAQ firming up, but finding resistance, and now testing VWAP in that point of control area. Remember, this is just a really easy way to look at your chart and see who might have control over a short time frame. If you're above both the point of control and VWAP intraday, and these are levels that I just start calculating when Globex opens at 6 p.m., if you're above those levels, that suggests that buyers are in control. If you're below both, that suggests that sellers are in control. So in a very short time frame here in the NASDAQ, some evidence that buyers are taking control back. And you can see that continuation here. And if you don't know, folks, I do have this on stream on YouTube. You can hit the link on my profile to get to the YouTube stream so you have the visuals I'm talking about. And if you don't want both running at the same time, you can mute the YouTube, or you can leave the spaces or mute the spaces, or whatever you prefer. Just want to make you all aware that we have that in case you wanted to see the video on it as well. Let's go back to the SPOOs here. SPOOs following the cues. No surprise there, but certainly another similar look. We've got price above the point of control and above VWAP. Institutions this morning have been largely net selling on S&P. You can see that with the iceberg number, negative 766 contracts here. Nothing big, but net selling into strength. And I like having that iceberg indicator on the subchart quite a bit. It helps me to get a better sense as to kind of what are some of the dynamics that are moving this market. Oh, I've got some questions here on the YouTube. I'm going to go through these. I've got just about 7 minutes left, so let me just go through these questions, make sure that I address them all for the folks that are engaged here. And so first, someone asks me, do I do the opening daily? I do not. I do this every Tuesday at 9 a.m. for Bookmap. And then on our Discord, I also periodically stream what's going on in the markets and talk about trading opportunities and so on and so forth. We also have a midweek recap that my buddy Horse and I record for Traderade, where we talk about what's going on at that point in the week with all the different asset classes and intermarket relationships that we track. So don't do this daily, but I do have a lot of different streaming content and then pre-recorded video content out there. Next question. What is a vol trigger? So a volatility trigger is going to be the largest area of gross gamma positioning below price. And so the vol trigger, when you pass below it, tends to increase volatility, particularly tends to increase the potential of downside risk. So that's something that you see if you're on the Traderade Discord. You'll see those labels in our Bookmap feed. This is a plugin that I created that goes through all the CBOE options data and actually illustrates these levels in a number of different ways. In charts, we have a bot that can output this info in text, and then we also have it on the Bookmap stream in case you just want everything on one screen while you're trading the market. You're welcome. How do I set up the lower right-hand side box? So it sounds like you're talking about the subchart indicators on Bookmap with liquidity differential, iceberg, stops, and cumulative volume delta. So in the baseline version of Bookmap, you get cumulative volume delta. It's built in. There's a free liquidity tracker plugin and a pro one. I use the pro one. And then icebergs and stops are available from the MBO plugins. So there's an iceberg and stops plugin that tracks the data from Rhythmic. So you need to have Rhythmic as your data provider to actually get that information. And then once you have all those plugins installed, you need to enable them. I recommend tuning them because, sometimes you get a lot of different information that you may not necessarily want. So I tune them for only important signal. And then, you can set up your subchart to look however you want. You can set it up to be vertical, horizontal bars, labels, circles, and so forth. So it's just a matter of doing some customization. Bookmap probably has some videos on that on their YouTube as well. So I hope that helps. We've got about 5 minutes left here. We're kind of stuck in the opening range here, so there's nothing decisive really happening yet in the S&P. In the NASDAQ, we're testing the top of that range. So we actually, we're seeing a breakout of the 20-minute opening range in the NASDAQ. Let's see if we can build some volume here. We may actually see a long opportunity if we start to build some acceptance up here. So that's where we are right now in the NASDAQ. 10-year note flat right now. Gold continuing to trend lower. I think there's a decent chance then we get to some of these resting bids below. Again, 1958 a key. Resting bid below. Crude continuing to trend lower. Similar look. 78.30 definitely on the map here in terms of these resting bids below us. And SPOO's now starting to look a little bit more sprightly, not quite above the 30-minute opening range, but certainly above VWAP and the point of control. NASDAQ continuing higher, so starting to build some acceptance up here, looking more constructive. Someone asks, Carl Jones asks, he says he's beginning to trade crude. Are there any indicators that you'd recommend? Carl, tell me more about your time frame. Are you trading intraday? Are you trading day to day? Are you trading week to week? What's your time frame for trading crude? Because that's going to affect how I talk about what indicators to potentially use there. And this is a question on the YouTube for folks that are on Twitter or Discord, just FYI. And again, NASDAQ is continuing to push higher, breaking above that 20-minute opening range, looking pretty constructive here as it builds volume above. S&P not confirming that yet. Intraday trading of crude. So, Carl, are you using Bookmap? Because that would be a pretty important tool. Look at this NASDAQ chewing through this liquidity, moving higher. This is a long here. We've built enough volume above. We're starting to make this push. I think from an intraday basis, there's room. You also see liquidity building up above on these resting offers. That's another thing that's really constructive to see. When price is moving in favor of that, it typically acts like a magnet. So NASDAQ looks like just an intraday long based on breaking out of that 20-minute opening range and building some continuation there. So yeah, so for trading oil intraday, back to your question, Carl, I would look at short-term moving averages. This is a very volatile instrument, so I'd always take very small position sizes in intraday crude trading because it can change on a dime. You're going to need wider stops than if you're trading another vehicle because of that volatility. And if you see in Bookmap, I'll put it on screen. The order book depth in crude is very small. It's 6.6 thousand contracts right now. That's not much at all. So that means it doesn't take a lot of order flow to move price a lot, which is another reason it's important to be very cautious of size. Yeah, so Bookmap is great because you can see how this resting liquidity can impact price. I would recommend having the MBO data so you can see icebergs and stops in crude. I like having the liquidity differential tracker on that and cumulative volume delta. So I use a similar set of tools that I'm using in SPOOs and Qs for crude, but I just tune it a little bit, right? So you don't want every iceberg and every stop to print. So you're probably going to want to increase your thresholds there to make sure that you're only seeing the more meaningful data so it's not clogging up your screen. And I'm taking this VWAP and point of control and I'm looking at the volume from Globex open, right, to kind of balance that out. So price below would have me looking at this a little more bearish, below point of control, and VWAP price above would have me look at it a little bit more bullishly. And similarly, finding the opening range that works best for you is really important. You can either use an indicator, you can eyeball it, but, you know, quantifying the opening range in crude, like recently we kind of pushed to a new opening range low and we're building some volume here, potentially accepting it. I think if we continue lower, that's going to be an opening range breakdown. That would tell me I want to short crude probably down to about 78 or so on that first kind of attempt. So let me know if that helps. Also, I think it's important with crude to zoom out, have a bigger chart like everything else, look at the day-to-day charts, so a daily time frame, weekly time frame, get some of your key intraday levels from those longer term charts, right? Because it tends to be actionable. You tend to revisit. Price has memory. And so understanding those really important areas of price action and where both people in the auction don't want to participate and really like to participate will help you because you can track those in your intraday chart and see how price reacts to those levels to get a little bit more of an idea. So let me know if that helps. Yeah, you're welcome. Absolutely. All right. So, folks, this has been a pleasure. Really appreciate it. You can find me at Traderade, traderade.com, and Macrovisor, macrovisor.com. Traderade, as the name suggests, more for traders. Macrovisor, more for investors. You can get 40% off Bookmap by visiting traderade.com/bookmap and just scroll down to the specials. And also, if you want 25% off visit Traderade.com and at checkout, type in Bookmap 25 for 25% off Discord. That first month, Bookmap 25 for 25% off. This is for the first 10 people, and the promo only lasts until tomorrow. Because we don't really need to sell it, but we want to give you all a little bit of a discount for tuning in, show my appreciation. So Bookmap 25 at Traderade.com when you're signing up for the Discord. So thanks everyone for tuning in. Really appreciate it. Check my YouTube out as well. I've got a live Bookmap feed that's on. You can always check out at youtube.com/@mayhem4markets. And if you're not already following me on Twitter, follow me on Twitter as well, posting regular insights throughout the week. So thanks again for joining me for this session of checking out Bookmap every Tuesday, 9 a.m. I hope to see you next week and be in touch throughout.